All right, so we are recording right now. What happened since we last met? How do we want to start this discussion off? Somebody got bumped today.
Yeah.
I'm not trying to hide it from you. Can you see the screen? Should be looking at the Wall Street Journal.
Yeah.
All right, so here we go. You only got 4 articles that I put up there for you to focus on. Who got bought today?
Yahoo.
Yahoo! Verizon has agreed to pay $4.8 billion to acquire Yahoo. I point this out because, again, we just had a discussion about how finance changes with times and perspectives change with time as more facts and more tests are run. Look at this. At the height of the dot-com era, this would be during the mid to late 1990s, up into the 1990s, 99, let's say. Yahoo, one of the few companies that was strong then and remained strong afterwards, but at the height of the dot-com era, Yahoo had a market capitalization of more than $125 billion. And they just sold for 4.8. Quite a significant drop in the value of a company in the last 20 years. Approximately 20 years. Now, the CEO, I'll point out some things to you. So when we talk about accounting, and we throw around smaller dollar amounts in class, but look at this. Yahoo's chief executive, Marissa Mayer, unlikely to have a prominent role. She's probably going to be dismissed or have a very minor role in the new company. But if she is terminated as a result of the sale, she must be paid $50 million. After earning, so since she's been the CEO, she has earned over $100 million in cash and equity. Equity being in the form of your stock options. Now, Yahoo is selling off its prized asset, and that is its internet search engine. Yahoo will plan to hang on to some more assets down here. Looks like there's the CEO. Looks like they're going to maintain about 3,000 patents that they own. And Yahoo also has a ownership position in Alibaba. And if you've not heard of Alibaba, think of it as a Chinese e-commerce. Think of it as the Chinese Amazon. But probably one of the, as far as a publicly traded and available to U.S. investors, Alibaba would be one of the larger, more pricey companies. But again, very interesting in that we will likely see, you're going to continue to see the name Yahoo, this article says, so I don't think that name will go away. Again, when we think of assets that, again, think of non-material assets. We talked about patents and we talked about goodwill. All right, that name Yahoo, again, if it makes me sing Yahoo, because you've seen that commercial, all right, then that's going to carry some value. So while the name Yahoo likely will not go away in the near future, we do expect to see at least them have common owner. Now, speaking of that 100 million that Marissa was just paid, here's a study that says, I'm going to paraphrase, but CEOs who are paid the most perform the worst. The highest paid CEOs are not performing as well in this 10-year study. CEOs of the highest, companies with the highest paid CEOs are performing lower, we'll just say lower than those of receiving smaller pay. And again, when I talk about CEO pay, that's a good figure right there to throw away. It's not uncommon that we might talk about hundreds of millions of dollars in any given year. So the old question comes in to play here, looking in the center. The idea that significant slugs of stock options or restricted stock will drive performance. The old saying was that if, when you look at how do you pay a CEO, now, I mean, think about this. All of us most likely earn wages. But once you're up into upper management, your position might call for you to receive part of your compensation in the form of stock options. In fact, here, 70% of CEO pay in the United States is tied up into equity incentive awards. What that would mean was if you were the CEO, your compensation will be tied to the stock price of the company you were managing. Everyone understand what a stock option is?
Yeah.
All right, so it would give you the option to exercise a buying of that stock at that strike price, whatever that price was that was stated in the option, or would give you the right to sell based on the strike price, the price in the contract. So again, if you are given stock and you're wanting to sell it, you have an incentive to grow that stock price in order to make more money. All right, so this is bringing into question if 70% of CEOs are paid through equity incentives. We're just saying the highest paid CEOs are underperforming lower paid CEOs in this study. The question must be asked, does paying a higher compensation result in shareholders' best interest, or at least internal company best interest? You see this question come into play a lot in today's economy. Take a look at, all right, Wisconsin. Who are your employers again?
My employer is Blueprint. Enterprise.
How big of a company is that?
Oh, it's getting pretty decent size now. We have, I want to say, 30 to 40 employees. Which when I started, that was like, at least, I don't know, we took on at least 10.
Okay. Where else?
I work for a privately owned neurology and neurosurgery office with between, over the past 6 years, 35 to 40 employees and 6 to 10 providers.
All right, now these companies might be, in the grand scheme of things, all of your employers would still be considered small firms based on the definitions I'm playing up here. A small firm could even be something with, where do you define a small firm? Some people would say 250 million and less. Wall Street might say 5 billion and less. So the definitions can change. But if you look at the pay, if we look especially at these top 100 companies and you look at the pay differential between the CEO and entry-level position or even middle-level position. Let's compare low manager to high manager on the corporate ladder. you're going to see a very wide stretch of compensation, wide stretching in the amount of money being paid. Your company's being smaller, no doubt, your CEO or president earns, I'm going to take a wild guess and say earns more than the person starting out, but I don't know that you would see that same wide stretch. So here we go. This has gotten the critics out, and as I said, you'll definitely see more and more of this. It's a presidential election. No doubt this might come up. Again, pay differential from the CEO, and how could it better be aligned to performance or goods or even society? What's your thoughts?
It doesn't surprise me.
I thought there were a lot of overpaid CEOs.
A lot of overpaid CEOs. Well, one thing I could argue is Wall Street has put, such pressure on some CEOs. Again, I'm one that believe not only should performance and compensation be tied to performance, compensation got to be tied to long-term results. Mm-hmm. Unfortunately, in today's world, today's economy, specifically pertaining to quick actions in the stock market, companies are usually judged 1 quarter at a time. I said this is earnings month right now. More companies are coming out. Tune in tomorrow and listen to Apple. Apple's going to announce some earnings tomorrow. And who knows? The last few numbers have not been positive, and their stock price has responded in a way that we would expect. But right now, it would just take 1 good quarter for Apple or any other company. Once they announce, it's kind of like past is forgotten. So if you're in controlling that ship, unfortunately, sometimes I think decisions are made for short-term profiting and short-term performance without any regard to, or let's say with less regard to, long-term. All right, you still seeing my screen?
Yes.
All right, chapter 14, we're going to talk about managerial accounting. The book tells us managerial accounting provides financial and non-financial information for managers of an organization and other decision makers. All right, who's the managers? Give me some definitions.
Employees in charge of other people or areas.
Yeah, people in charge, people who have management responsibilities, your CEO, your CFO, department heads. Okay, in order for these department heads to do their job, they're going to have to rely on internal accounting statements. They're going to have to rely on managerial accounting. I want to point out here that managerial accounting, look here, it is accounting done for internal operations. Unlike its sister, financial accounting is done for who?
External?
External users. Financial accounting through external users must adhere to specific financial and tax principles such as GAAP and the International Financial Reporting Standards. Managerial accounting does not have to follow such rules and regulation. Managerial accounting, again, is done for internal use. Therefore, your internal reports that you're generating are going to be customized toward those internal purposes. Now, they're still going to follow basic accounting principles. We're not just going to create measurements. We're not going to recruit. We've got to follow basic accounting principles. But again, it's not so much of do we have to follow specific principles. I shared a news article with you, I think, this week about more companies signing on and using GAAP, and how they report income and what should they pull out before they report income. And again, this whole topic of one central reporting and how strictly GAAP might be followed is again something that we're debating and what we must follow. All right, so again, purpose of managerial accounting is forms of planning and strategic decision making. It's going to help managers determine the cost of an organization's products. It's going to help with planning future activities. And it's going to help compare the results to planned results. Think of your budgeting here. Again, it's going to help you compare planned results with actual results. Here's a good slide of a comparison between managerial and accounting, or managerial and financial accounting. Here's 7 key areas. First one being the users. Again, external versus internal users. Look at number 3, structured and often controlled by GAAP. Managerial, relatively flexible. There are no GAAP constraints. What comes to mind when I say Arthur Andersen, Enron, WorldCom, Bernie Sanders? Fraud. 2014 report estimates the average U.S. business loses 5% of annual revenues on fraud. All right, fraud's going to involve the use of one's job for personal gain through deliberate misuse of company resources. This can range from theft, misuse of office supplies. Speaking of that, ask yourself an honest question. Have you ever taken something from your employer?
Yeah.
There's 2 yeses. I don't know which. In Wisconsin, I only heard 1 yes, so
Oh, yeah.
do not speak up. Don't feel like you have to incriminate yourself right away, or at least not as quickly as these other 2 office thieves.
You just jumped right in there, didn't we, Tyler?
I mean, we're honest, you gotta go do it.
No hesitation. Everyone, I think, at some time has. And I'm going to say things because I'm not going to accuse anyone, but, technically that would be paper, pencil, paper clips, postage stamp.
Using the copy machine.
Using the copy machine.
A really nice stapler.
The stapler, you are correct. So 5% of its annual revenues. Now, let's not focus so much on this internal side, but let's look more at it from, in looking at this internal side, I think we bring up ethics. Again, and that is distinguishing what's right and wrong, and as humans, we put weight on what is right or wrong. But if we look at external fraud, we're going to introduce the Institute of Management Accountants. Management accountants. Somebody tell me what this is.
Wait, we can see the articles. Is that what you're still trying to share, or are you trying to go to the PowerPoint?
Are you seeing the PowerPoint?
No, we're seeing the articles.
On our computers, yes, but not on your shared screen.
All right, so y'all missed the first three. I don't think you really missed.
We followed along, but yeah. Okay, there we go.
Okay. Again, you have access to these presentations in the discussion area, and again, I'm putting them up on the screen. You have access in the discussion area to my notes that are on there. Here, what's being recorded, we're looking at just the presentation. All right, so what's the Institute of Management Accountants, or IMA?
Association of Accountants and Financial Professionals in Business.
All right, again, the Professional Association for Management Accounts. All right, these are going to be your folks that represent, just think of it as a society of managerial accountants. And again, the association that is going to help structure or help guide or help represent this area. Again, came up with a standard of ethical and professional practice. And again, require that management accountants be competent, maintain confidentiality, act with integrity, and communicate information in a fair and credible manner. It's a textbook starting point of where you would think the golden rule. All right, now again, we distinguish between fixed and variable cost. If not, go to YouTube and look at cost accounting. Fixed costs do not change when activity changes. Whereas, what's variable cost?
It changes as
Variable.
activity.
All right.
All right, changes with and as activity changes. Give me an example of a fixed cost.
Your rent. Well, hold it.
Regardless if you spend one night there or 30, your rent expense is likely going to be the same each month. What about variable costs?
Variable could be like how much money you spend on your groceries a month, or your gas.
Taxes. It changes.
Gas. Amount of money you spend on groceries. In business, let's look at fixed, again, could be rent. If you were a trucking company, transportation, yes. Gasoline, the more freight that is hauled, the more miles that are recorded on your fleet, the higher your fuel costs are going to be.
Mm-hmm.
All right, look at it this way. Direct costs can be traceable to a single object. Indirect costs cannot be traced to a single object. So again, direct costs are going to include material and labor costs for a product. Where's this going to be included, do you think? In which account? When we're trying to determine gross profit,
It's going to be in your expenses.
correct, or it could be included in cost of goods sold. Again, direct costs traceable to a single object used to produce that product or service. Indirect cannot be traced. So here, a maintenance expenditure benefiting more than two departments. So type of classifications by function. All three are going to be included as product cost. direct labor, direct material, and manufacturing overhead. When I say overhead, what are we referring to?
Overhead is how much, I don't want to say stuff you have, but the amount of money that it takes for you to be in full operating business. Like the cost of your building and employees, electricity, water, things like that.
Correct. Overhead refers to production costs other than direct materials and direct labor. All right, period cost. Non-production costs and usually associated with activities linked to a time period more than with completed products. Who can think of an example?
If you like run an event or something, is that an example?
If you were running an event.
Yeah, like if my work sponsored an event, like pertaining to car dealerships or something like that, would that be a definition of period costs?
Yeah, if we classify selling expenses or general expenses, admin expenses,
Mm-hmm.
I think if your event there would be geared towards selling, we call it a selling expense, that's period cost.
Okay.
And again, activities linked to a time period rather than completed products. So if you were going to run a sales promotion for, a particular time period, we would likely include that as a period cost. All right, let's look at how all this flows to our financial statements. Okay, period cost. All right, let's first work ourselves over from the left. We're going to talk about 2015 cost incurred. From there, we break that down. Is it a period cost in the form of expenses, or is it a product cost representing inventory? Period costs, where do they flow to?
Operating expenses.
Flow directly to current income statement as an operating expense. Period costs are not reported as assets. Now, what about product cost? Where are they first assigned?
They go to inventory, but it depends on what year you're looking at.
They go to inventory. Now, where they go from there, the final treatment is going to depend on whether or not they were sold or disposed. When were they sold or disposed? In this case, 2015 or 2016. Let's assume they're sold in 2015.
So it goes to cost of goods sold.
They're reported as cost of goods sold on the 2015 income statement. Now, inventory not sold until year 2016. They are going to carry forward on the balance sheet as of 2015 year end. So on December 31st, 2015, it has not been sold. So it's going to remain on the balance sheet. Now, if that inventory is sold in 2016, look, it just flows up to cost of goods sold, and at that point is recorded on the 2016 income statement. So you assign product cost first to inventory, and then you must determine when was it sold or disposed of. From there, you know which is going to flow to the income statement, but you'll know which annual income statement to report it. All right, here's some good classifications. Bicycle tires. It's variable. More bicycles that we would manufacture, the more bicycle tires and wheels we must have in inventory. It's direct. It can definitely be linked specifically to that bicycle, and it's a product cost. What about rent?
Rent is fixed.
Rent would be fixed. All right, now, see if we have anything with multiple classifications. Sales commissions. Everybody see how that would be variable?
Yeah, because it would range on what the employee is selling.
Correct. More sales would result in a higher commission.
Mm-hmm.
Direct or indirect?
Well, it says indirect. I'm trying to figure out why.
Let's think about this.
I would think that you would be able to attach a commission to a specific salesperson.
Well, you would attach it to a specific salesperson. All right, a direct cost, material and labor cost for a product.
So in the fact that the product is already made.
In the fact that you are not involved in the production of that product.
Okay.
You did not have the labor for that product. Therefore, it's an indirect. And again, it is a period because it's going to involve one specific period. All right, let's look at it. We looked last week at a merchandising company. Let's kind of explore more along service-based. Okay. Southwest, okay, we're looking at beverages for Southwest Airlines. A variable cost based on the number of passengers. All right, so we assume we're in one flight. The airline's cost of beverages for passengers on that flight is going to be determined. It's variable because it's going to be determined based on how many passengers that are aboard that plane. All right, if we look at it over the course of a month or even a day or across the whole fleet, again, how many flights do they have? So total passengers flying is going to be a very variable cost. All right, let's look at this. All right. Classify each as a product cost or a period cost. Then classify each of the product costs as direct material, labor, or factory overhead. What are we going to call plastic board used to mount the chip?
It's direct or direct material.
Is it a period cost?
It's a product cost.
Okay, so we're going to call it a product cost, and we're going to say it's direct material. Okay, advertising cost.
Advertising is a period cost.
It is a period cost.
And it's indirect.
Or are we going to classify it direct material, direct labor, or factory overhead?
I think it'd be factory overhead.
Factory overhead, I will agree with you.
Okay.
What about some of these others? Any of them giving you second thoughts?
Number 3, is direct labor.
Number 3, factory maintenance,
Direct cost.
workers' salaries.
Why would the real estate taxes paid to a sales office be a period cost and the real estate taxes paid on the factory be a factory overhead? Wouldn't you kind of assume that that is also fixed and would be a period cost? Why would they be different?
All right, so why is it different? Because when it's paid on a sales office versus paid on the factory.
Yes. They're considered different costs, but I guess I'm not understanding why.
That which one?
All right, paid on the sales office, we're going to call it a period cost.
Right.
All right, why would we call it a period cost when it's paid on a sales office?
Because it doesn't go into the making of the product.
Because you're selling something?
But you're...
It's going to be traced right back to that office. It's not going to be part of factory overhead because it can be traced back to that office.
So it's a direct cost. But what makes that a period? So, I mean, okay, so I'm understanding that it's a direct cost, but what makes it a period cost?
When do you pay your real estate tax? When do you pay your home tax? Taxes on your home?
Normally once a year.
Probably once a year.
Mm-hmm.
All right, the sales office would be no different. Therefore, that's why it's the period.
Because it can change, like the taxes on it can change every year.
Real estate taxes paid on a factory. Is it going to benefit more than one department?
Yes. So it's an indirect cost. And in the fact that it's a factory, it's product cost because it's necessary in order to make the product. So it's considered overhead.
Correct.
I totally don't get that.
It's benefiting more than one department.
Real estate taxes paid
On the factory.
on the factory.
So everything encompassed under that factory, you're paying taxes on the factory. So it's benefiting more than one department. And Taylor, what else did you say?
I remember where I left off. Oh, it's considered factory overhead. I think we covered the other ones, right? Yeah, it's indirect, it's a product cost, and it's considered overhead because it's needed in order to make the product.
And it's again affecting more than one department. department. All right. We start all over. Okay, in today's products, what do we find?
Bulk is under material.
Well, majority being under direct materials. All right, now when we distinguish between merchandising and service-based company, this pie is going to be split differently. All right, the main difference between merchandising and manufacturing companies is that merchandisers buy goods ready for sale, while manufacturers must produce these goods from acquired materials and labor. So again, merchandising or purchasing materials already available for sale. Manufacturing have to produce the items to sell. Think of Amazon. Again, we talked about Alibaba earlier. Think of Alibaba. All right, it's a merchandising company. It's going to buy and sell goods without physically changing them. Go to Amazon. You can search for, I'm guessing, anything. I had a mechanic in the office today telling me that he loved Amazon because he could find car parts cheaper on Amazon.
Mm-hmm.
That was,
Also,
so
First place to shop, not gonna lie.
your favorite place to shop?
Yeah. You know, like my boyfriend and I were looking for a stereo for our garage. And we went to like secondhand stores, and we went to Walmart, and then we found the exact same one at Walmart on Amazon, and it was $30 cheaper, and we got free shipping.
Cheaper on Amazon versus being in the store.
Yeah, by like literally $30, and it was the exact same thing. Like we took a picture of it and everything.
You cut out all those people in your Walmart store. If you look at my Amazon activity, I love it because it's just a little purchase here and there throughout the year, and then come December, toward the end of December, you see one big spike in activity. Last year, I set out to see if I could, and ladies, I'm going to say I'm not a shopper. My wife would tell you in 10 years of marriage, she could count on one hand how many times I've been in a mall, or how many times I've been in a grocery store. I can be found at Golf World or Golf Galaxy, and the only reason that is everybody gets me gift certificates to Dick's or one of these golf stores. But last year, Christmas 2015, I set out and I could purchase and do all my shopping online. And I was really impressed because leading up to that, throughout the year, starting in about the fall, I'll start thinking about gifts, and I created a list of items that I wanted to purchase. And I went out on Amazon, or I went online. I'll say probably greater than 75% of all the items were found on Amazon. And I purchased everything. And I did it. What I loved about it is I did it all in one evening.
Mm-hmm.
I sat down in my recliner. I had my favorite adult beverage, and even lighting the fireplace and do your shopping. For a boy who never goes in the mall and has bad memories of going to the mall around Christmas time, let me say I further plan to exercise my right to shop online again this year. All right, so on the other hand, Nike. Yeah, I'm thinking of my last purchase on Amazon. I purchased a pair of shoes. Nike. Now, are they going to be a merchandising or a manufacturing company?
Manufacturing.
Manufacturing. They've got to go and buy the leather and the cloth and the dye and the glue to hold it all together and the laces and those little plastic tips on the end of the laces and all of that. Then they've got to go and acquire the labor to put all of that together and maybe produce that shoe, again, to make it available for sale. All right, so we can see that we're going to see a difference between service and merchandising companies, and we'll see a different split between merchandising and service-based companies. All right, direct materials. Expenditures for direct materials that are separate and readily traced through the manufacturing of produced goods. All right, first off, are they tangible?
Yes.
Direct materials are tangible. Examples, steel used in the frame of a mountain bike. But just remember, it is a tangible cost of the finished product. Direct labor. All right, here, I'll paraphrase. Direct labor is going to refer to the collective efforts of employees who must physically convert materials into a completed product. So who's going to take the materials and assemble it into a bike and get it ready for sale? All right, now that would be anyone in that assembly. That's going to include your welders, your painters, again, to the person putting the spokes. And factory overhead. All right, here you go, factory overhead. All manufacturing costs that are not either direct labor or direct material. Remember, they cannot be readily traceable to finished goods. Factory overhead costs are considered to be indirect costs. Again, indirect labor cannot be directly traced to the product. Indirect materials can be materials used as part of the final product, but they can't be readily identified to a specific product unit. All right, now at some point, following good economic principles, we got to see if they cannot be directly related. You know, how much detail do we keep in keeping track of at some point? You know, when it comes to cost accounting, I always have somebody ask, does it matter, you know, if we're tracking office supplies, does it go down to, you know, yes, if every single paper clip, for example. Yeah, I guess if we wanted to go to that minded level, paper clips would have an individual unit or cost. They would still be factory overhead, but you know, what would they, you know, could we assign, or is it worthwhile to assign? All right, manufacturing costs often combined as follow. If we take direct materials and direct labors and combine them, we say this is a prime cost. What's a prime cost?
Expenditures directly associated with the manufacture of finished goods, which includes both direct materials and direct labor costs.
Correct. It's a combination of direct material and direct labor, and are those expenditures directly related to the manufacturing of finished goods. Now, what do we get when we combine direct labor with manufacturing overhead?
Conversion costs.
We get conversion costs. Who wants to tell me what are conversion costs?
They are expenditures incurred in the process of converting raw materials into finished goods.
All right, and which one has a unique distinction of being in both prime and conversion costs?
Direct labor.
Direct labor. All right, so the balance sheet. All right, here again, distinguishing between a merchandising and a manufacturer. The main difference is going to be that merchandisers, again, buy goods readily available for sale. Manufacturers must produce the good using raw materials. Let's look at how this affects current assets. Here we go. What difference do we observe?
Inventories.
Again, inventory, because the manufacturer has to acquire raw materials, process those raw materials into finished goods, and get them ready for sale. So on the balance sheet where we record our assets, what are we going to have to do? We see here that on a balance sheet of a manufacturer, they're going to have 3 inventory accounts. Whereas if we were looking at a merchandising company, we would see it as a single inventory account. All right, with a manufacturer, 3 inventory accounts, we're going to call them raw materials, goods in process, and finished goods. Raw materials, we're waiting for these to be processed. These can be direct or indirect. Goods in process. These are items that are partially completed. So we've already added some labor and overhead to them. And again, finished goods mean they're ready for sale. When you're tracking this, you know, let's look at this as managerial accounting. Picture yourself being the CFO. This would probably be one report that you would want to pay attention to. This could address a lot of concerns. This could address bottlenecks. Everyone know what a bottleneck picture? The flow can only be as fast as the narrowest point in the bottle. So if I have all these raw materials sitting there with little goods in process and less finished goods, am I in a good position? Now I'm going to assume I'm not a startup, assume that I'm a company with ongoing operations. Would it be good if I had an abundance of raw materials, less goods in process, and even less finished goods?
No.
No.
I hear no. Tell me why.
Because the finished good is what you sell.
Finished good is what we sell. We don't get paid until we sell it.
Revenue until we sell.
In addition, think of it this way. Those raw materials, we've already spent the money to acquire it. We now have it. Once we have it, what are we responsible for? Well, we pay for it, but at the same, think of Ford Motor, goes out and buys all this steel for the manufacturing of its truck. I guess aluminum in the case of Ford now. All right, so it goes out and buys all this aluminum, top selling truck. If it doesn't have a lot of going down the assembly line, what must it do after it pays for that aluminum? What must it do with it?
Make something out of it.
Well, before it even gets to that,
The foreman,
if you go out and buy something, what'd you say?
the foreman, they have.
You have to
protect
form it,
the
but more
aluminum.
importantly, you've got to ship it to where you're going to need it. You've got to protect it. If you're not ready to introduce it into goods in process, you bought it. It's an asset. But you've got to pay to store it. You're probably going to pay for insurance. There's a lot more cost associated with those raw materials. So again, we want to quickly see that once we acquire it, we are putting them into goods in process. On a side note, I'll tell you to go out and take a look at a concept called just-in-time. And again, it will address some of these concerns that I just said about acquiring those raw materials and the timing of those raw materials. Now the income statement. What's the difference between the merchandiser and the manufacturer? Again, it's going to be the items making up cost of goods sold. Look at this. With the merchandiser, cost of goods purchased, again, you're purchasing them readily available for sale. With the manufacturer, cost of goods manufactured. You're going to actually, once you acquire them, again, we have to assemble and we have to assume all costs associated with acquiring all the way to completion of final product. Once we get that completion of final product and we sell it, we delete it from inventory. Let's look at an actual statement. Okay, again, Telemart as a merchandiser versus Rocky Mountain Bikes as a manufacturer. Let's look at the merchandising company. Again, cost of merchandise purchased. We have beginning inventory. We have the cost of purchasing goods available for sale, and then we're going to back out, be left with ending inventory. But with the manufacturing company, we've got cost of goods sold, beginning inventory. Again, the change is going to be how we treat the cost of goods. Again, asking, is it with a merchandising company? Again, we're requiring it ready for sale. With the manufacturer, we've got to, we're responsible for costs and we're incurring costs from acquisition all the way to the end. All right. Well, I gave you the answers there. My finger's gotten ahead of my here we are with just in time. Give me 1 second here. we see each other once again. What questions do we have there?
Pretty good on this one. See, this stuff I understand. So when we go through our homework, are we gonna do the just-in-time? Like, is that gonna be in there, or is that just like terminology, future reference type of thing?
Well, let's think about just in time. What do we know about it? We're going to cover it here in a second. I want to actually move on down there.
Oh, okay. I can wait if you want me to.
Well, right now, let me get this. All right, so this is going to delve a little bit deeper into the income statement. But let's talk about just in time. All right. What is just in time? When we think about it, what type of management are we referring to?
Last minute.
Last minute. It's part of a concept called total quality management. It's going to put its emphasis on total quality. It's going to work on all aspects of business activities, again, looking for improving quality. It's going to seek to uncover waste. It's going to encourage your employees to try new methods, again, striving toward improved quality. You're going to emphasize the value of quality through some type of quality award. So again, basing some type of award based on quality. Just in time. First off, who created just in time? Who must we give credit to? Too often we get credit from all right, one company that always comes to mind in America is Ford Motor Company, Henry Ford. And first off, everybody, I hear often Henry Ford was the one who created the automobile. That's incorrect. And Henry Ford started just in time. Incorrect. Henry Ford was the first person to modernize the assembly line. And again, the assembly line is based off it's probably the very beginning of what we recognize as just in time. Again, we must give credit to the Japanese for this total quality management principle and for just in time. But it's going to assume that this manufacturer is receiving its raw materials when? Just in time for production.
Mm-hmm.
If you've ever seen a good plant operate using just in time, I'm going to give credit again to the state of Kentucky and Toyota. All right, in the early, I think it was the early 1990s, Georgetown, Kentucky brought in Toyota's first North American plant. And again, as a student there in the central part of the state, you know, my brother now currently lives there in Georgetown, and I remember living on a farm and all of the farmland. Georgetown is a suburb of Lexington. It's the horse capital of the world. So again, think of thoroughbred horse farms and the Kentucky thoroughbreds and retired Kentucky Derby winners. But then all of a sudden, Toyota comes to town. And then every person who is responsible for supplying raw materials to Toyota start popping into town. And they like to build those plants really close to that production site. Again, it's not uncommon that the delivery truck is pulling up to the factory, literally pushing parts out at that specific point on the assembly line when they are needed. The timing of this has become remarkable. So again, just in time is going to assume that raw materials are received just in time for production. What about completed products?
They're shipped to customers just in time or
Just in time. So you don't have those costs associated with warehousing and protecting and storing, safeguarding. You know, the one example I think of right now, I credit, I think now you can probably buy a Dell computer in an office store, but prior, when Dell computers first, when Michael Dell created that company, you know, it was unique in the fact that you logged on to Dell, you literally built your computer right there. You clicked on everything you wanted. I recall going in there, how big of a screen do you want? Here's the prices of it. Click on it. Here's the prices of how much memory do you want? Click on it. And you assembled your computer. And when you hit buy, just in time started. That computer was not built until you purchased it and paid for it. And then it was assembled in 24 hours and shipped out. So again, it was determined that they would have access to those raw materials. And again, so just in time is going to assume that you have the raw materials just in time to manufacture and that you are going to have the the finished goods ready just in time for sale. All right, now the value chain, that's going to be referenced in your slide. I'm not going to go over this. One good ratio. Raw materials. OH. I've written this accounting equation up so often I put OE for owner's equity, but in this case, I'm going to abbreviate overhead with OH. Raw materials used divided by what?
average materials inventory.
Average materials inventory. Why is this of a concern? As a managerial accountant, as a CFO, why might you ask for these?
So you can see how much you're producing and how much raw material or how many raw materials you're using on average. And keeping things in inventory.
How often you're keeping things in inventory, correct. How often are you turning over that inventory?
Mm-hmm.
Correct. Again, trying to eliminate that bottleneck of having too many raw materials, not enough in production, not enough being sold. All right, if you have a high ratio, what's that going to tell you? All right, generally you're going to prefer a high ratio. If you divide this out, you are going to prefer a high ratio. That means you're efficiently turning over. That doesn't mean we strive for the highest of ratios, but you want to still make sure you have adequate supplies or at least quick access to the raw materials needed for production. So while we strive for a high ratio result here, we want to first ensure that we have adequate access or adequate supplies of these materials. Any questions about chapter 14?
Is our homework going to be giving us things like the factory overhead and well, the cost of goods? We can figure that out, but as far as like the factory overhead, like the base kind of information that we're going to need?
It will either give you the amount or it might give you some cost and have you distinguish. I've not looked at the homework right now,
Okay.
but I could see it just giving you the cost and having you distinguish, is it direct or is it overhead?
Okay. And then for the raw materials turnover, the lower ratio, does that mean that you have just too many raw materials that aren't being used, or just like not enough production, or both? I mean, I know there's a problem either way. If you have like a low ratio.
Low ratio, what does that lean towards?
If you have a low ratio, that's going to lean toward you have too much raw materials.
Okay.
So you're going to be setting idle. You're not going to have enough in production. You know, the general rule, here I'll put on my statistical hat here. And again, we always have expected outcomes. When we apply a ratio, you have an expected outcome range of results. You know, if all of a sudden you are a student and you're making hundreds, you're excelling, and then all of a sudden you had an F, would that be something out of that range? Yes. All right, we call that in economics an outlier. When you're looking at these ratios, you're still going to have an expected range. If you've been with a company long enough or you're looking at past results, you're going to see something that's within that expected range. It's when your results fall outside of the expected range, you're going to investigate immediately. That is an outlier. It should, while it might not mean anything, depending on the result, it might be insignificant, but still you're always going to want to prompt further research and probe a little deeper.
Mm-hmm.
If your expected range is still down on the low or on the high, on either side, it's probably going to probe further investigation. And again, keeping in mind, merchandising versus the manufacturer. You know, it's nice to say, it's quicker to say that you're acquiring those goods readily available for sale. But again, manufacturing, got to acquire the raw materials, go out and find the labor to assemble it, and then prep it for final delivery. So there's just a few more steps. When you look at the balance sheet, remember, single inventory line for a merchandising company. With the manufacturing company, inventory is going to be broken down into three classes, three accounts. Again, raw materials, goods in production, and finished goods.
At any point in time, do the manufacturing accounts and the merchandising accounts, are we gonna see both of those at the same time? Like, could you be a company that both makes and sells other products?
Could you be a company that makes and sells other products?
Like, you can manufacture a product and sell that, but within that company also sell other goods that you purchase? Are these two concepts from last week and this week going to be mixed together?
Could we have a company that manufactures and
I guess within the home
I'm going to sit here and say outside of this classroom, in the business community of today, companies do, I could see a company, yeah, I mean, I'm sure there's companies that sell readily available items, and then same companies come out and produce those.
like for the purpose of the homework and knowing the accounts, are these two going to be mixed together?
No.
So we won't get to a point where the manufacturing accounts are credited like last week's were with
Go right back, stop right here. That same, what we opened up with, assets, how to debit and credit, how are we increasing and decreasing, using T accounts under our basic accounting equation. That principle is going to apply throughout all entity types.
Right, but I mean with like the returns on sales, in last week's homework and some of the ones I was trying to get through, it's talking about, defective merchandise that they're returning. Is that going to come up in today's homework? Are there certain accounts we should be using for that, like debiting accounts receivables and crediting sales, and then on a return we would be debiting the sales returns and something else and then crediting, you know what I mean? Is there a pattern for returns in the manufacturing world?
Well, with manufacturing, now we're looking at manufacturing. Again, we're looking at that three-step process. Acquiring raw materials, processing raw materials, work in progress, or goods in process, and then again, preparing for final delivery. So with the manufacturing in this class, we're looking at inventory in that three-step. With that merchandising company, look at it as we focus more on pushing it out the door.
Right, but if we acquire materials that are damaged and we have to return them, for example, and that's going to show up in our homework as one of these journal entries, which accounts would be affected in that case, I guess?
You mean if you acquire raw materials and those raw materials are affected or defected, you must return them.
Right.
Now, are you asking what you would do, or are you going to see it?
Well, those are the things that I don't understand. Like going through the power.
Right. For the purpose of this class, then I'm going to ask you to contact me. We're running out of time. We're out of time. I want you to contact me outside of this class. Contact me. Put that as your first question that you are going to send me. Now, for this video, I'm going to have the closing arguments right now and stop recording. So again, if you have anything to say, now's the time.
Nope, I'm all good.
All right. Thank you.